This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
What do you say to people scared stiff in cash?
We've got an administration, presumably, that will be pro-business, lower taxes.
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Tom Keene off yet again today. Jess Menton sitting in for Tom. Is he in Paris, Rome, London?
I feel like he might be in Paris.
Okay.
Because of just some things he's been posting on the Twitter.
All right, very good. I'm never sure where he is. I know he's not on the Upper East Side. He's somewhere just fabulous. So anyway, we appreciate Jess coming in and sitting in. We got a lot of stuff coming up today. We're going to check in on, obviously, former President Jimmy Carter passing away. We'll have some thoughts on that as well. We're going to talk about these markets. We're going to have Cam Dawson, CIO at NewEdge Wealth. She's going to be in our studio today, giving us her thoughts about a 2025 outlook. Paige Henderson, Senior Portfolio Manager, Head of Resilient Global Equity Team at Allspring Global. I'm not sure what that is, but that sounds kind of cool. We'll talk about markets there. So we got a lot coming up here. Futures a little bit light here this morning on December 30th. Not a lot going to be happening here, I'm guessing, over the next couple of days. But we're here.
That's right. S&P 500 still up 25% year to date,
awesome.
on pace for its best year since 2021.
And we had a ripping year in 2023.
That's
so
right.
We got 2 years,
Two consecutive
in a row,
years.
exactly, of 20% plus growth. What do you do in 2025? I have no idea, so I'll turn it over to Lisa Mateo. Maybe she's got a Bloomberg Business Flash. She can help us out here. Lisa, what do you got?
You got it. So we got futures falling. Investors kind of trimming their risk heading into year end. Right now, NASDAQ futures down 0.2%, 51 points. S&P futures down 0.2%, 14 points. And we have Dow futures down about 0.1% or 80 points. Heading over to the bond market, the 2-year yield 4.29%. That's down 3 basis points. The yield on the 10-year 4.59%, and that's down about 3 basis points. To currencies, we have the Bloomberg Dollar Spot Index down about 0.1%. Japanese yen up 0.1% at 157.62 against the dollar. We have the euro, British pound stronger, and Bitcoin up about 0.5% at just over 93,000. A light economic calendar as we close out the year. Today, we got to look at pending home sales. Tomorrow, it's a report on home prices. Keep in mind, markets close for New Year's Day on Wednesday. Now we go to shares of Jeju Airlines. They're down 8% in Seoul. That's after falling 16% to a record. You heard about the deadly crash of one of its aircraft on Sunday. Now the stock of its parent, AK Holdings, that's down about 12%. And that plane was also a Boeing 737-800. So now Boeing shares down about 3%. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Bloomberg Surveillance today is brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. 1924, the year President Jimmy Carter was born. Same year my father was born.
Amazing.
Extraordinary. 100 years. It's just amazing. You think about the life that President Carter had. It's just extraordinary. You want to there's so many different facets to his life: pre-presidency, presidency, and then of course the post-presidency, which just as amazing. My sister did Habitat with Humanity for President Carter and his wife for decades. They went all over the place. Haiti, everywhere, and it's just an extraordinary life. Terry Haines joins us. He's the founder of Pangaea Policy. Terry, it kind of feels like, we think about our current economic and our current political environment, it kind of feels like Jimmy Carter was from another time and place. How do you think about his legacy these days?
Paul, I think a lot about President Carter's presidency and his legacy, both. There are some resonances with today's political situation. A lot of people point that out, but I fundamentally, I would say that markets need to give President Carter a huge debt of gratitude today for not only appointing Paul Volcker and breaking the back of inflation, but also setting the run-up of U.S. economic strength that persists even today. So there's a big linkage between Carter's presidency and today, and Carter defending Fed independence by shielding Volcker's ability to continue to apply those policies, which is something that President Reagan also did. Beyond that, I think about Carter having a very fractious relationship both with his own party and with the other side. Then that and a lot of geopolitical bad fortune really helped to make him a one-term president.
Of course, to your point, Terry, he was a one-term president, but it was his post-White House work that Paul was just mentioning about that seemed to really define him. Talk to us more about that.
Well, President Carter wanted to live a useful life, not as a president, I mean, including as a president, but wanted to live a useful life as a person. And the degree to which he focused on that and kept to it, his sheer stick-to-itiveness on all that really defined him. And, and you've mentioned some of his many, many good works. And, and I don't need to remind the audience of many more that are being written about today, but between Carter and Nixon, and I'm not engaging in whataboutism here, those two individuals really, particularly Carter, I think, really defined what the post-presidential role of American presidents are, and his continued involvement in public service in lots and lots of different ways is a very positive part of his legacy, and one of the main things for which he'll be remembered.
Terry, I know that President Carter kind of continued some of the efforts that was begun during the Nixon administration in terms of normalizing relations with China. How do we think about that process, that time and place versus kind of where we are today?
Well, in that time and place, it was very much in the United States' interest, following along President Nixon's opening to China, to continue that policy. And, Carter is responsible for one of the, ironically, for one of the main flashpoints today, which is the ambiguity, strategic ambiguity, the United States calls it, over the status of Taiwan and Taiwan policy generally. I don't fault Carter a bit for that. That happened in 1978 or so. It was a very long time ago. But it shows the United States' interest in wanting to bring China into the community of nations, and the United States' interest in wanting to encourage China along the path of economic expansion. And both of those things resonate today, both good and bad.
Also expand a bit more on when it came to Carter reorienting U.S. foreign policy towards that emphasis on human rights.
Yeah, that was very controversial at the time, and remained controversial. Carter was very critical of the realpolitik, as it was called, in the Nixon and Ford administrations, and wanted to introduce a more robust emphasis and focus on human rights. That became a hallmark of his presidency, and again had good and bad resonances. I mean, he certainly helped human rights and helped focus the United States on the human rights dimension of foreign policy, and at the same time, a lot of what ended up happening was things spilling over in a variety of ways that caused his presidency in the United States great difficulty, from Iran to Russia's incursion into Afghanistan and beyond. So his legacy there is very good, but the foreign policy results were and remain mixed.
Terry, the National Energy Act kind of got us thinking about conserving energy, renewable energy, recycling. Talk to us about his legacy there.
Two things. One is that Carter himself. There are a lot of dimensions to this. One is that Carter himself was very convinced very early on remember that his presidency comes in the aftermath of the first gasoline oil shock. that very convinced that the United States had to lead on energy policy and not only adopt an energy policy domestically, but one that was very different from the laissez-faire policies before. He set about doing that. That cost him a lot of political support in his own party, as well as with just kind of Texas oil state Democrats and the like. I mean, it was by no means a unified party on this. So that alone cost him a lot of support, number one. Politically, but he is responsible for a lot of the architecture of what we deal with today. Secondly, Carter on energy shows the limits of the presidency as much as anything else. Carter thought he could lead by example and frankly dragging both the public along and his own party and Congress along. And he found out that Congress is a co-equal branch of government and was very willing and able to push back at him on this. And there was a lot of dissension in the public as well on what President Carter thought the remedies were, including turning the thermostats way down and alternative energy. So, he showed the limits of the presidency by that, and it's part of the cautionary tale of the Carter view.
All right, Terry, thank you so much for joining us. Really appreciate getting some of your perspective there. Terry Haines, founder of Pangaea Policy, with our news in New York City. Here's Michael Barr.
Paul, Jess, Lisa, tributes continue to come in for Jimmy Carter. The 39th U.S. president has died at the age of 100, leaving behind a legacy of promoting human rights and peace around the world. President Biden delivering remarks in St. Croix late Sunday and remembered Carter as a good family friend and remarkable leader.
Millions of people all around the world, all over the world, feel they lost a friend as well, even though they never met him. And that's because Jimmy Carter lived a life measured not by words, but by his deeds.
Former President Bill Clinton and former Secretary of State Hillary Clinton added that Carter was guided by his faith. President Carter lived to serve others until the very end. Wendy Schiller, director of the Alfred Taubman Center for American Politics and Policy at Brown University, says, though Carter's presidency had bumps along the way.
He also wanted to change the narrative of the United States from being sort of responsible or participating in war to promoting human rights and peace. He just didn't read the signals, I think, in the Middle East as well as he should have, particularly Iran, and that really cost him dearly.
Wendy Schiller, director of the Alfred Taubman Center for American Politics and Policy. President Biden will order a state funeral in Washington for Carter with a national day of mourning on January 9th. The U.S. is sending a team of investigators to South Korea to examine the wreckage of the jet that crashed upon landing Sunday, killing 179 people. South Korean officials say air traffic control warned the pilots of a possible bird strike. Moments later, the pilots issued a mayday call. The people of Southwest Texas will close out 2024 dealing with the devastation left by a rare winter tornado. It was one of at least 50 twisters reported across 7 states over the weekend. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Lisa.
All right, Michael Barr, thank you so much. We appreciate it. Jess, I think about President Carter, again, born in 1924, the same year as my father. My father was scheduled to graduate high school, Trenton Catholic High School, June of 1942. The Japanese bombed Pearl Harbor, so they moved it up to March so the boys could go and into the service. President Carter goes into the Naval Academy, graduates, and then goes into nuclear submarines, which was at the very cutting edge of technology at the time. I mean, it's just amazing to think about that part of his life and his career in nuclear-powered submarines. They didn't know what that was yet. These young men would go into the service. I find that one of the most amazing parts of his life.
Yeah, one of my grandfathers was in the Navy, so obviously he had to deal with lots of submarines. But it's amazing throughout Carter's life and how much he was able to do throughout, obviously, a century of life there.
Yeah, amazing. And his wife lived until just a couple of years ago, 2023, she passed. So just amazing. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio. I'm Lisa Mateo. Well, we've got red on the screen, and this is after the holiday shortened week ended with a big sell-off in the tech sector Friday. Now, shares of mega caps, including Tesla, Nvidia, Netflix, all saw losses. This morning, we'll check in. Tesla and Netflix both down more than 1%. We have Nvidia down almost 0.5%. Now, since we mentioned Nvidia, let's check in with some other chip makers. We'll go to Broadcom down about 0.5%. Intel down nearly 0.5%. Over to NASDAQ futures, down 0.3%, 64 points. Dow futures down 0.2%, 89 points. S&P futures down 0.2% or 17 points. The 2-year yield at 4.29%, that's down 3 basis points. The yield on the 10-year 4.58%, and that's down about 3 basis points. To commodities, NYMEX crude up about 0.5%, $70 a barrel. Brent crude $74 a barrel. We have spot gold lower at $2,617 an ounce. And to currencies, the Bloomberg Dollar Spot Index down about 0.1%. And Bitcoin, again, can't forget that, up about 0.5% at just over 93,000. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate it. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Jess, Michael Barr was just talking about Times Square New Year's Eve. Have you done that? Did you ever do that?
I have not.
Lisa Mateo, you have done Times Square New Year's Eve. I'm guaranteeing.
You crazy? I would not stand out in the cold.
No. I did it once, 1986. And I did it once. I could say it's a bucket list. You can tick it off. Most people in the world can't say they've done it. I've done it.
That was right when you went to Wall Street, right?
My first year.
First year on Wall Street?
Yeah, we worked till like 8 o'clock and went out and we were working New Year's Eve, and then we went out and it was... I'd never do it again.
Never do it again.
Yeah.
All right, so
checked it off the bucket list.
All right, you got to do it. I think Michael Barr might be there this year. All right, let's talk about these markets here. We've had, again, 25% gain in the S&P 500 this year. Not too shabby. What do you do about 2025? Stocks, bonds, alternatives, all that stuff. Anna Rothman joins us. She's a CIO at CBiz Investment Advisors. Anna, again, a couple of great years for the stock market indexes. What are you telling your clients about 2025?
Good morning. There's some nervousness going into 2025, and especially because of the calendar year effect, right? You turn into a new calendar year, maybe the sentiment, and that could happen. But we do think that may be short term. I mean, you can have any kind of short term technical moves, and we do expect that. But you have to sort of think about, in terms of relative value, where would assets go? If we're looking at building a strong portfolio that's supposed to last in terms of robust portfolio construction, you have international equities, you have U.S. equities. From that standpoint, we think that U.S. still has leg to run, even with high valuations, because the international equities might be a value trap. And in terms of U.S. equities, we still think that tech has some room to run, even if there's some short-term volatility, because has sort of become the utilities of modern times, as well as a defensive move, because frankly, their balance sheets are pretty healthy and they've been doing really well in terms of earnings, relatively speaking, and they have really good cash flow. So, it's hard to tell if when tech is running, it truly is a risk-on move or if it's actually a defensive move. And from that perspective, even within a slowing economy, global economy perspective, we think it's okay to stay in U.S. markets and especially tech.
And you brought up valuations. If you look at the S&P 500's blended forecast over the next 12 months, it's around 22, Paul, in the terminal based on Bloomberg Intelligence's data there. But if you strip out the Mag 7, even then it's still around 20. But I mean, Sam Rose pointed out, he had a good column a couple weeks ago, you can't use valuations as a timing tool. And that's also kind of what you were hinting at, Anna. So what do you like to use as far as, because obviously valuations and then sentiment, and even if people want to argue if sentiment is stretched, that stuff can go on for months, even years before things kind of peter out.
Absolutely. I mean, we were worried about concentration a year ago. And if you had actually not been in some of those Mag 7 stocks, you would have lost out, right? So definitely not a timing tool. So CBiz is a long-term investor, which means we have a strategic portfolio allocation. And what that means is that when the market runs, no matter how much we think it's completely irrational, we let it run in the portfolio. But what we do is we take the emotion out and we rebalance regularly, which means we're taking the irrational gains and putting it into things that are less valued with lower valuations. And we continue doing that, then that's where the benefit of diversification is, through the act of rebalancing. If you don't rebalance, then you just basically have assets invested in different asset classes. That's it. So it's really rebalancing and taking the emotion out and letting the irrational markets run. That's what we do.
Anna, in your notes today, it's something interesting I found. 60-40 is not dead, but it won't be your mother's 60-40. What do you mean by that?
So I wondered if I should use my mother's or my grandmother's, because, starting in early 80s, I mean, we're talking about the late Jimmy Carter today, and it took me back to the 80s and Volcker. Your grandmother might have enjoyed a falling yield environment for decades, right? Where you have good income and price as a tailwind because the yields were coming down. And then maybe your mother was like, okay, we're in a zero rate environment, very low rate environment where you don't have very good income. You're going to have some price volatility, but you still have to have bonds in your portfolio to hedge against the equity beta. Today, we have respectable income, but we have price volatility. We think that yields have some room to go up still, especially in the longer end. Carry, you should probably have some credit spread in there. The high yields this year is a perfect example for that, of the power of carry. We think that income is going to protect against some of that price volatility, but you're going to have that price volatility. From that perspective of interplay between income and yield, and therefore price volatility, we think you're in a completely different environment, but you should still have bonds to protect against and diversify against equity beta.
I just pulled up the 60-40 model portfolio in the Bloomberg terminal that we have. So it's actually up. Yes, so we do have it. It's actually BMA 60-40 index. So you can look at that. And if you put it on an annual basis, you can see it's up about 16% this year. So obviously on pace to be up higher in 5 of the past 6 years. Paul's wondering how I figured it out. It's because I'm on the equities team. So I have I have all of these things saved in my G. But I wanted to point out, because when we're talking about the direction of yields here, when we have the 10-year still nearing higher to where its high was actually around 4.7 was the high this year. It was around 4.6 at the end of last week. So where do you see the 10-year Treasury yield as well as the 2-year yield headed in the next year, depending on the direction of Fed policy?
Yeah, so the 2 years is going to be dependent on the sentiment around what we think the Fed is going to do. Again, I'm hedging it like doubly, right? What we think the Fed is going to do. So it's a little bit more tied to the Fed, but certainly the 10-year, and this is another reason why we're not in your mother's or grandmother's 60-40. We're in a completely different debt to GDP ratio environment. I know we talk a lot about U.S. debt, but even when you compare it to debt to GDP ratio, we didn't look like this back in the 80s, 90s, or the aughts. So we think that's an upward pressure. We also think that we're in a completely different inflationary environment. I do think that the Fed might be talking about this. I don't know. I'm not in their discussion. But 2%, we need to revisit that. And we need to really talk about whether or not that's a realistic goal without slowing down the economy. And we think that we're in a higher for longer inflation environment. And that all of those things just basically mean higher 10-year yield. And that's one of the reasons why we think there's going to be price volatility. So 4.6, 4.7, not unrealistic to think that that's, maybe on the low side in the next 2 or 3 years.
Anna, thank you so much for joining us. Anna Rothman, CIO at CBiz Investment Advisors, Cleveland, Ohio.
Ooh.
Yeah. She had like a PhD in voice or something. She's multi-talented in addition to being a top investment officer. So we appreciate getting a few minutes of Anna's time. Looking at the futures here, a little bit of red on the screen here. S&P off about 0.3%. The NASDAQ off about 0.4%. Yields, I'm going to look at the 10-year Treasury. We're off about 3 or 4 basis points, 4.58 on your 10-year Treasury. WTI crude oil pretty steady here, just under $71 per barrel. And Tom Keene in his cafe in Paris, 93,900 on his Bitcoin. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks adding to Friday's declines on Wall Street. This is over a pullback in the Mag 7 tech mega caps that have really powered this year's rally. We'll start with NASDAQ futures down 0.3%, 84 points. Dow futures down 0.2%, 103 points. S&P futures down 0.3%, or 22 points. The 2-year yield at 4.29%, down 3 basis points, and the yield on the 10-year 4.59%, and that's down about 3 basis points. Let's take a look at the holiday market schedule because, let's be honest, market news flow is pretty dull right now. So the market's open tomorrow for New Year's Eve, but keep in mind the bond market closes 2 p.m. Wall Street time. Yes, exchanges in London, Hong Kong, they will close early tomorrow. There's no trading in Japan. Now we get to New Year's Day. U.S. stock and bond markets will be closed. Yes. Okay, over to currencies. The Bloomberg Dollar Spot Index down about 0.1%. We have the Japanese yen up 0.1% at 157.59 against the dollar. The euro up 0.1%. Same with the British pound, and Bitcoin up nearly 1% at just above 93,000. Shares of Nissan, they're lower in Japan, down more than 5%. This is, of course, over concerns that the terms of its planned deal with Honda would give investors a lower stake in the proposed joint holding company. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. You know what's? Tom's not here. But Rich Truman is also not here, so I don't have somebody yelling at me.
That's right.
Early in the morning.
Always a good time, though. He means the best.
Exactly. All right, let's talk about these markets here. What do we do going forward here? It's a nice time to sit back and reflect. Good 2024, good 2023. What do we do about 2025? Stocks, bonds, all that kind of stuff. Janet Mew joins us. She's head of market analysis at RBC Brewin Dolphin. Janet, before we go any further, RBC Brewin Dolphin, explain to me what that is. Where did that name come from?
So Brewin Dolphin was the leading wealth manager in the UK, and RBC has acquired us back in 2022.
Nice.
So we combined, and our entity is now called RBC Brewin Dolphin.
Love it. Very good. Thank you. So, Janet, again, we look back at these markets the last couple of years. Equity investors have had really, really positive returns when you look at the S&P 500. What's your framework here for asset allocation, putting money to work in 2025?
Yeah, we had a great year in 2024, and we believe that it could be more of the same in 2025. And of course, we're watching very closely the earnings growth outlook and also the potential trade tensions in the global economy. I think as long as the U.S. economy continues to grow and inflation does not exhibit high volatility, steady as it goes, even though it could stay elevated for a bit longer, I think the markets can still continue to grind higher as long as there's growth and as long as there's earnings growth outlook. So broadly speaking, we're constructive on equities, and that positive view is particularly strong in the U.S. equities. We believe that there's still going to be much divergence between U.S. growth and the rest of the world.
Paul, I was taking a look at the latest EPFR data that Bank of America does modeling on. So last week, equities had their largest weekly inflow on record, and U.S. equities in particular, $82 billion that continued to flow in, even though we had some days that were pretty volatile. Exactly. So you're still having a ton of money going into the year. And so, Janet, what I'm curious about is when you're looking at particular corners of the market in industries and sectors, because you were talking about the earnings outlook going into next year. Bloomberg intelligence data has the markdowns more toward those sectors that are tied to commodities, say energy and materials. How do you view maybe some of the other corners of the market, like healthcare, real estate, maybe materials, potentially picking up steam next year, depending on the outlook when it comes to earnings growth?
Yeah, so in our favorable U.S. equity outlook, basically, we're still very much constructive on the tech sector, particularly the Max 7. We believe that the AI theme is still going pretty strong, and I think a lot of that benefits are likely to be more felt by the cloud computing companies like Alphabet, Amazon, and Microsoft, for example. I think those will be big beneficiaries. And with that, we still need a lot of semiconductors, so we're still constructive on that sector, the whole value chain. And also with that, we need a lot of energy, so we're still positive on the energy sector outlook. And I think healthcare is a very secular trend that we are positive on because of the aging population. So that is an area that we continue to be constructive on. So I would say tech, particularly mega cap, and energy, and also healthcare.
Janet, I know you're based there in London, actually right around the corner from the Bloomberg headquarters there, Bishopsgate. I know it well. What do you think about the UK market here? I see valuation as a real attraction there in the UK market. I can buy the UK market at a big discount to the US market. Is it worth it to look for value in the UK stock market?
I think on index level, we're neutral. I think although the UK market is highly exposed to international factors, I think the domestic factors and investor sentiment still matter a lot. And on that, it's not very constructive at the moment, given the challenges of the tax hikes and the confidence of businesses have actually plummeted. So I think we have to be a bit more cautious on that. But on that front, as you say, valuation is attractive. So I think within the index level, I think individual stock level, there is bargaining opportunity that exists. And I think within that, we continue to like dividend payers. We like the nature that the UK stock market has one of the highest dividends paying companies in a major developed economy. So we continue to like that theme. And otherwise, we can continue to look for individual stock picking opportunities in the UK market. But broadly speaking, we're neutral on the index level.
And Paul, you were mentioning obviously value stocks. If you look at the S&P 500's value index, actually earlier this month, there were 14 consecutive sessions of declines. It was its longest losing streak on record based on the data that we have going in the terminal. So Janet, when you're thinking about sort of value, even when you're thinking about also small caps and those getting beaten up, on pace also for small caps, fourth consecutive year of underperformance relative to the S&P 500 and its worst performance since 1998, if those losses can hold obviously through tomorrow. How do you play something like that when you continue, to your point, and y'all still like when it comes to growth and other corners of the market there? How do you play that, and will we ever see a rebound in those type of corners of the market?
To be honest, I think it's a very difficult call. I think I would still prefer the growth style stocks and the mega cap stocks. I think there's a case for small and mid cap stocks to rebound at some point if growth turns out to be very strong. But I think the fact is, if you look at the fundamentals, the profit outlook is still much better in the large cap space and in the growth areas that is supported by technology and innovation. So I would say I would still prefer the large cap, and I would need more evidence to be convinced to rotate into smaller caps and value stocks.
Janet, how about in the world of fixed income? I mean, investors can sit here in a 2-year treasury, U.S. government treasury, 4.3%. That seems like a decent way to make a living. Do I need to take credit risk above and beyond that? How do you think about fixed income?
We are broadly neutral on the asset class level, but within that, we have a preference on government bond over credit. And I think you're absolutely right. I think staying short duration and the front end absolutely makes sense if you're concerned about uncertainty. I would be cautious about going a bit longer duration, given that I think 2025, a lot of focus will be on the budget deficit and debt situation, which ultimately could put pressure on the longer end rates. For credit, we don't think it is worth taking the extra risk at this point because the spreads are just at very, very compressed levels relative to history. So I think the risk reward is just not justifiable. But I think when you think about uncertainty next year, a lot is about the trade tensions. It could be about the Middle East tensions and, a lot of things that we can't foresee, like shocks. So I think there is still a place for government bonds to play in portfolios as a hedge against this risk. So that's why we still have a preference on government bond over credit.
What about when it comes to mid-cap stocks? Because Goldman Sachs had some data earlier this year where they talked about when the Fed first begins its cutting cycle 12 months out, usually mid-caps end up outperforming small caps and large caps. How are you positioned in that corner?
I'll say my preference would still be large caps in the US. But if I were to choose between mid caps and small caps, I would choose the mid cap stocks because, again, I'm always referring to the fundamentals. The profit outlook and the margins are just better than the small cap. I think small caps, you really need a strong economy and a lot of rate cuts, but that is unlikely to materialize next year. So I would say I would prefer the mid caps to the small cap at this stage.
Janet, is there any sector in the marketplace or factor in the marketplace that screens well for you guys right here as we start 25?
Well, again, I think we keep coming back to this, but it's really technology sector exposed to artificial intelligence that we really like. I think it is really the sector that it has done very well, of course, and valuations are more elevated, but it is still the best growers in terms of earnings, and you can't really argue against that fundamentals. And I think investors will continue to pile into that trade. And the other areas that I mentioned will be healthcare. We think, again, it is a secular trend, which is aging population. And we think that we have a few selected companies that we like that has exposure to longevity and innovative healthcare, particularly for the elderly. So I think these two sectors would be our favorites.
All right, Janet, thank you so much for joining us there. Janet Mew, she's head of market analysis at RBC Brewin Dolphin, located over there in London. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Jess and Lisa. Tributes for former President Jimmy Carter celebrating his life and mourning his loss Sunday at the age of 100, the oldest former U.S. president ever. President Biden, delivering remarks in St. Croix late Sunday, called Carter a good family friend and remarkable leader.
He used to kid me about it, that I was the first national figure to endorse him in 1976 when he ran for president. There was an overwhelming reason for it, his character.
Former House Speaker Nancy Pelosi praised Carter as the first president to warn Americans about climate change.
He knew that there was something happening with the environment that we had to be in charge of and not just respond to.
President-elect Trump saying Carter did everything in his power to improve the lives of all Americans. For that, we all owe him a debt of gratitude. Earlier this year, Carter's grandson revealed his grandfather was holding on to cast his vote for Kamala Harris. The vice president writing in a statement, "His life and legacy continue to inspire me and will inspire generations to come." South Korean officials plan to conduct safety inspections of all Boeing 737-800 aircraft operated by the country's airlines as they struggle to determine what caused a deadly weekend plane crash. The plane skidded off a runway at Muan International Airport and slammed into a concrete fence, bursting into a fireball. All but 2 of the 181 people aboard were killed. And Tony Award-winning stage actress Linda Lavin, who became a working-class icon as a waitress on the TV sitcom Alice, has died. Lavin was already a success on Broadway when she was chosen to star in a new CBS sitcom in 1976 based on the Oscar-winning film Alice Doesn't Live Here Anymore.
See, Mel, it isn't always convenient when you have a kid. You take him when you get him, like I got him at 5 in the morning.
Lavin's representative says she died Sunday of complications from lung cancer at age 87. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Lisa.
All right. Michael Barr, thank you so much. We appreciate that. Jess Menton, what are you looking at in these markets today? What's jumping at it? Because I know you write like 17 Bloomberg News articles a week. I mean, what are you looking at these days?
So I actually just put one in our
Of
chat,
course
and
you
this was actually one Alex Simonova and Sagarika. She's
her.
one of our counterparts over
She's our
in
buddy.
Europe. So they cover sell side research. I know obviously you did your sell side time on Wall Street for a long time, but they were looking at yet again the forecasters who got it wrong with the rally, and we do continue to see this year after year, and especially not even just the last couple of years, but there's been a history of that happening, as you know. So it actually goes through and it looks at great charts in this story, so I highly recommend going through and doing that. And then you can see sort of where the targets were going into this year versus where obviously the S&P 500 ended up ending. But what I like to do, if you go to the S&P 500 and do the A and R function, because I know you like to look at that, Paul, you can look at the estimates even going into next year right now. So right now the average for 2025, 6,500, so that would be roughly just a 9% growth rate from where we currently closed through Friday's close. But even there, if you look at the last few years, even though obviously we had a bear market in 2022, we've continued to see double-digit growth here for a while.
Pretty solid. Nice to be an equity investor. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got futures slipping after a Mag 7 sell-off weighed on stocks on Friday. Right now, NASDAQ futures down 0.8%, 178 points. Dow futures down 0.6%, 270 points. And S&P futures down 0.7%, or 45 points. The 2-year yield at 4.28%, that's down 3 basis points. And the yield on the 10-year, 4.58%, and that's down 4 basis points. To commodities, we have NYMEX crude. That's up about 0.5% at $70 a barrel. We have Brent crude at $74 a barrel. Spot gold is lower at $2,620 an ounce. To currencies, the Bloomberg dollar spot index is down about 0.1%. We have the Japanese yen up 0.2%. Euro, British pound stronger. We have Bitcoin up at around 93,000. Few companies making news. That's AT&T and Verizon. They said they were hit by the China Link Salt typhoon hack, but that their networks, they are now clear. And Elon Musk's growing influence in U.S. politics, changing the way some countries are looking at its Starlink internet business. Bloomberg reporting many governments are removing obstacles to its operations in their markets. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. I'm looking at the weather app here, Jess. It looks like it says 75% chance of rain tomorrow. Does that impact all those folks that are going to be out there in Times Square? They just going to say the heck with it?
You know, I feel like some people are going to be diehard. They'll still be down there regardless.
I think so. I mean, it's going to be warm tomorrow. I mean, so it's not going to be cold. So in Times Square, it'll be warm, maybe get a little wet, but
I think when they lock you in, I don't think you can have alcohol down there.
Yes, well, you can't get out. So.
Yeah, exactly. You're in there. You're locked in.
So in 1986, we worked till like 8 o'clock. We went to a steakhouse across the street, had a big dinner. We expensed it to a client, I'm sure. And then we kind of walked down towards Times Square. We got to like 45th Street maybe, and then the crowds got too. And we saw the ball drop, and we're like, okay.
And then you were done.
Yeah, we're off. Let's go somewhere else.
Yeah, partied somewhere else.
That was that.
Now, a look at the front pages. What's making news around the world? Your daily roundup of today's headlines from major publications.
All right, your daily look at the front pages around the world is brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. Lisa Mateo, what do you got in the newspapers today?
Sure. I want to point out what Michael Barr has been talking about, the tributes for former U.S. President Jimmy Carter. They keep coming in. You had President Joe Biden called him an extraordinary leader, statesman, humanitarian. You had President-elect Donald Trump, who said all Americans owe him a debt of gratitude. Then you go to former President Bill Clinton. Remember, he awarded Carter, his late wife, the Presidential Medal of Freedom. They said he worked tirelessly for a better, fairer world. And even President Barack Obama said President Carter taught us all of what it means to live a life of grace, dignity, justice, and service. But they're coming in from worldwide, not just from around here. And we've been talking about it all morning, not only in the White House, but what he's done outside of that.
Yeah, I saw a tweet from Admiral Stavridis, who was a guest on Bloomberg Surveillance. Oftentimes, he's a voice we really look to for geopolitics. Obviously, a Navy man. He said, just kind of highlighted the fact that he was the only graduate of the U.S. Naval Academy to be president. So I thought that was pretty cool too.
Right, and typically you have a market holiday once, I believe potentially it might be on the 9th, if that's the national sort of day. Usually the markets are closed on that, but we'll see what the New York Stock Exchange and others say about that.
If they do, yeah. That is true. Okay, I want to go to this Wall Street Journal study. It shows how people with higher salaries and net worth tend to live longer lives. But here's the thing, though, that stood out to me. It's not just about how much money you have, but also how you spend it. Okay, so this was in the JAMA Internal Medicine. Once Americans make it to the late 50s, the wealthiest 10%, they live to a median age of around 86 years. Yes.
Wow.
So that's about, listen to this, 14 years longer than the least wealthy 10%.
That seems...
Yeah, so they get into kind of the reasons why. I mean, you think about it, people with more money can afford healthier food, more health care, homes in safer, less polluted neighborhoods. They stress about less things like how to put food on the table. Like, you don't have to worry about that. A lot of lower income jobs are pretty physically demanding. But the interesting part was that it's not just about how much money, but how you spend it. So they suggest certain things, how you can reduce stress if you don't have all the money. Okay, so you do the at-home gym equipment, right? You can't afford the gym membership.
There you go.
I'm a huge proponent of that.
Does it count if you watch somebody do
It
the
does not.
workout?
No,
We
you
cheer
have to
someone else
Yes,
on.
I do that very well.
to partake, but just going out walking, like maybe go out for a walk on the beach. There you go.
We did that
See,
yesterday.
you could do that. Good. Limiting the screen time, before bed. That's another thing.
Oh, it's hard.
Okay, how about this one? Drinking less alcohol, eating less restaurant food. Okay, it's not only good for you; it's going to save you some money.
All right.
No, you're not.
All right,
lying.
here's a
Have fun.
gerontologist from Cornell University. I often tell people one of the best ways to stay physically and cognitively fit is to go into ballroom dancing.
Oh, have you tried it?
I have not.
Ooh.
I'm not a dancer.
Maybe in the-
no surprise to anyone in this.
New Year's resolution,
Yeah, maybe.
2025.
Exactly.
It's a good workout, I'm telling you. Also, those gadgets, they say like the Apple Watch, so what is it, the Ring, the Oura Ring, all those things.
No.
They say they're good.
Paul's not into it.
please.
It keeps you on track. I don't know, it makes you a little paranoid about your health too, but at the same time, it does keep you on track.
Are we legs or arms today?
Today is actually my day off. I hurt the leg skiing, so
nice.
I'm taking a little bit of a breather.
That's right. You went skiing this weekend.
I
So
did, and you were mentioning the
Tweaked the knee.
weather.
Yep.
The rain, not good for the
No,
toe.
it's not good. No.
It was back
No.
by where we were, like all in Camelback and Jack Frost and all that area.
Yep.
Ooh, hit
Yep.
hard by that rain.
Yep, not good.
There. Okay, so this one I thought was interesting, also in the journal. Fewer higher level jobs, right? So you have corporate America thinning out the management ranks. So this is Live Data Technologies. They say U.S. public companies have cut their middle manager headcounts by about 6% since the peak of the pandemic hiring spree. A lot of the biggest cuts, human resource departments. But because of that, you have former bosses that are shifting to non-supervisory positions. You have workers rethinking their career paths because they're saying, well, if I'm not going to get up to this next level, what am I going to do next? And then the managers who did survive, they have like 3 times the workload on their plates. So all this, and then the companies are also struggling with how to motivate the workers who just feel burnt out and who feel like they're stuck.
Yep.
So it was pretty interesting.
Well, I worked on Wall Street my whole career, and there's an ageism issue, which is late 40s, maybe 50. That's it for 90% of the professionals on Wall Street. You age out, and for a variety of reasons, one of which is you've become too expensive, and you can find somebody lower cost to do your job. That's it. I'm telling you, 90% of the professionals on Wall Street, you age out at late 40s, maybe 50. That's the bad news. The good news is you've made a good living through those years that you have options. You can go to Bloomberg and start a research department, for example. But I mean, and then go into radio. So, but that's a thing. I'm telling you.
Yeah, and they also say too AI could be like a part of that because that could be taking over some of those positions as well. So something to think about. Right. And the last one, this was a study in the New York Post that I found. Remote employees feel their social skills have declined when they're working from home. So this is from ResumeBuilder.com. 25% of those who work from home say that their social skills declined. Millennials, they say, are the most susceptible to it. Things like initiating conversations, right? Making eye contact, taking part in group discussions.
Whoa, what about Gen Z? Why do they always have to beat up on the millennials? What about that other one behind us? Millennial. But like, hey, what about the Gen Z?
Gen Z is what? Like they're younger, right?
They're younger. Okay, yes, they're the ones after me.
Okay,
they're the babies.
Those are my kids, I guess.
Yes. But that's what they're saying. Just because they're kind of growing up in it, I guess that's what they know.
So my daughter, who I have a ton of respect for, she's so much smarter than her knucklehead brothers. She's 4 days a week, but it's a stretch. She feels like it's an imposition, I think, to be 4 days a week.
Office.
Yes, and as opposed to just a more flex hybrid thing. But she's reasonable. She's not like, I think she's a totally reasonable representation of her age group, but it doesn't seem natural to them. Why?
Right.
Like, well, I don't know.
I mean, I was always going into the office before COVID, so it's different. But I mean, we're still all here, obviously.
My thing was, I mean, for first 25 years of my working career, can I get a day off? Can I please get Sunday off? Because we work Saturdays, and do I have to come in on Sunday? Really? That was such a drag.
It was.
But we got paid for it, so what the heck?
But you did. But then the ageism thing doesn't help with it. Anyway.
All right, Lisa Mateo with those newspapers making you think every day. Looking at the futures here, we definitely got some red on the screen here. The S&P off 0.9%. I'm calling out the Dow Jones Industrials for John Farrow. Who knows where he is? It's off 350 points. That's 0.8%. NASDAQ off 1%. We'll have more coming up. This is Bloomberg. Some good to meet you.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
I'm sorry, it's a boom economy, and that's what we're adjusting to.
Neither party seems to want to take on deficits at all.
With Lisa Mateo on markets.
Stocks are coming off another record high.
And Michael Barr with news.
Tensions between the U.S. and China have heated up even more.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Solid hour coming up here. Our bookers are working hard today. Kim Dawson, she's in our studio, CCC of NewEdge Wealth. We love talking to Kim, get her thoughts on these markets going forward. Paige Henderson, Senior Portfolio Manager, Head of Resilient Global Equity Team. They're resilient there, and they're at Allspring Global. There's some smart folks. They're out there in Milwaukee. Again, pound for pound, the smartest money managers I've ever found are in Milwaukee, Wisconsin. I have no idea why, but we'll have some thoughts there. Winnie Cisar, Global Head Strategy at CreditSights, talked about fixed income and the bond markets in 2025. So we got a lot coming up in this hour. Bloomberg Surveillance Today brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Lisa Mateo's got our Bloomberg Business Flash. Lisa, what do you have?
You got it. We got futures falling, investors trimming their risk heading into the year end. Right now, Dow futures, they're down about 0.7%, 333 points. We have NASDAQ futures down 0.9%, 210 points, and S&P futures down 0.9%, 54 points. Now, as we mentioned through Friday, the S&P 500 actually up 25% in 2024. It's on pace for its best year since 2021. So right now we have the bond market. The 2-year yield 4.28%, down 4 basis points. The yield on the 10-year 4.57%, and that's down 4 basis points. To currencies, the Bloomberg Dollar Spot Index down about 0.1%. We have the Japanese yen up 0.2%. Same for the euro. British pound up 0.1%, and Bitcoin up nearly 0.5% at just over 93,000. A light economic calendar. We close out the year today. We get a look at pending home sales tomorrow. Report on home prices. Markets close for New Year's Day Wednesday. Then the data resumes Thursday. Construction spending, initial jobless claims, and manufacturing PMI. We have shares of Jeju Air. They're down about 8% in Seoul. That's after falling 16% to a record. That's after that deadly crash on one of its aircraft on Sunday. Now, the stock of its parent, AK Holdings, that's down about 12%. And that plane was a Boeing 737-800. So now Boeing shares down about 3%. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. We have no idea where he is, but some European capital, we are sure, enjoying a beverage of his choice. Right. Exactly. Very much. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. 20% plus gains in 2023 for equity investors, 25% gains so far year to date in 2024. I mean, what do you do in 2025? I'm just going to go in my 2-year Treasury at 4.28% and just park it all right there. I mean, why take any more risk? But let's see what the pros are saying. Cam Dawson, she's the CIO of NewEdge Wealth. She joins us here in our studios. Cam, what are you talking to your clients about? I know you've been marketing a lot, talking to your clients over the last several weeks, several months, and going into 2025. What are you telling them about how they should be thinking about 2025?
We're saying that you should not be surprised if forward returns are lower than the last 2 years that we've experienced. And if we were to have another year like 23 and 24, we think that would propel us into bubble territory because of where we're starting with valuations. So we actually think a sideways, somewhat choppy year is the best thing to happen for this market, simply because it would allow us to grow into these higher valuations. And in sideways choppy years, usually 2 things happen. The first one is that you have leadership rotations. The second one is that you do get great buying opportunities. So even if it isn't an as exciting of a year from an overall total return perspective, you're likely going to get opportunities to increase equity exposure simply because of that chop.
It seems like the last few years in particular, coming out of COVID, there's so much doom and gloom in 2023, 2024, where people were really underestimating the strength of the economy. And we were just talking about sell-side strategists notoriously getting those calls wrong. Next year, they're calling for maybe on average around 9% gain in the S&P 500, but we've continued to see double-digit gains year after year here. So when you're thinking about potentially broadening out, are you thinking maybe the unloved corners, maybe say like a healthcare or real estate, materials? Are we going to see a bid for some of those that haven't been participating in the bull market run over the last 2 years?
I think when we think of the broadening, we have to do it in 2 kind of distinct time periods, because right now we're going into 2025 with those unloved areas being so very unloved that they are primed for some kind of snapback, but we're not quite sure if it's sustainable, meaning that you could see a 2-week or a 1-month period where value and unloved areas just have a quick snap re-rating. But then the question comes to earnings. And one of the reasons why you have seen these areas underperform so much is because their earnings have been actually rather abysmal. Don't forget, healthcare started this year with an expected 20% growth in its earnings for 2024. The end number will be closer to 3%. So you have to see that deliver.
So if people are underestimating tech again and are doubting that and then potentially miss out on another run, what exactly do you do? Where do you position if you're concerned about particular corners of tech, but maybe there's other areas within that group that you can invest in?
We're not quite sure if they're underestimating tech at this point because estimates have been raised so much. If you think of the growth index, it's expected to go from 4% growth in earnings growth this year to 16% growth next year. But the kicker in that is that the Mag 7, which is about 55% of the growth index, is set to decelerate materially next year because we lose that supernormal growth from the names of like NVIDIA and Amazon.
And like the base effects, like the year-over-year effects not being as strong.
Exactly. We have tough comps going into 2025. So if you think about that 4 to 16% acceleration in growth earnings, it means that it's coming from the 45% of the index that's not Mag 7. And that's a pretty high bar. So we're not quite sure if we're going to be able to deliver on that degree of growth earnings, which again feeds into this notion of maybe it's sideways chop if we can't get that full growth that's currently being priced in.
So do I spend more time in my fixed income part of my portfolio here and think about a 2-year treasury at 4.3%, maybe even taking some credit risk? How do you think about fixed income in the portfolio next year?
Well, fixed income from the credit perspective also has extraordinarily high valuations. Credit spreads remain very tight. They're near the lows of the year. That's actually a good message from equity markets, at least in the very short term, meaning that the equity volatility we're seeing is coming more from interest rate volatility, maybe some positioning, not necessarily growth fears. But if growth fears start to bubble back up, that's where credit spreads would have a lot of room to widen. We also think that uncorrelated assets that don't care about the Fed, assets that don't care about equity markets, are a more attractive place to be in 2025 as well. So we look at very esoteric types of assets like litigation finance, but also things like infrastructure. Infrastructure is an area where it's been unloved because it can't compete with 20% plus returns. But if you could give me something that's high single digits that is not correlated to equity markets, maybe that looks more attractive.
Is that a 3M, a Caterpillar, those types of names? Or is it something really infrastructure funds?
Actual infrastructure funds, because if you look at the valuations of those industrial cyclicals, those are also trading at very elevated valuations. Industrials got up to trading 24 times earnings just a couple of weeks ago. So we're not sure that it's there that you necessarily want to be positioned simply because you're pricing in some kind of growth reacceleration that may or may not materialize.
Talk to us about your view of the bond market, because obviously over the summer when we had real yields, people looking toward that direction for a steepening yield curve, and whether that was pricing sort of the risk for a recession. But then obviously we've seen revisions to some of those jobs reports from earlier this year, like in obviously July and September, and then a blowout report in September. And so how do you view that in the direction of the bond market and kind of what that's telling us about the direction of economic growth?
Certainly the last 4 months of the jump in the 10-year yield is a combination of pricing out of recession risk. I think it's also pricing in some kind of risk that the Fed could be too easy when financial conditions are already very loose, as well as the fact that too easy when growth is already robust, meaning that you don't necessarily need deep interest rate cuts to stave off some kind of recession, and so that likely is feeding into where yields are. The one thing we're watching really closely is that we have seen economic surprises turn lower, so just economic data is beating less than expected. You're not seeing it have those kind of revisions upward to the same degree as it was earlier in the year. And so as yields have climbed, economic surprises have turned lower. Those things typically move in the same direction, so there is a notable divergence.
Folks, I'm telling you here, I mean, the week between Christmas and New Year's, a lot of people mail it in. Cam Dawson did not mail it in. She gave us a note today with so much stuff in there. It's going to take me a couple hours to read here.
Sorry.
NewEdge Wealth, folks. Go to the NewEdge Wealth. And check out Cam's research there. Some great stuff. Cam Dawson, thank you so much for joining us. She's the CIO of NewEdge Wealth. We appreciate getting a few minutes of her time and her research note today. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Jess, and Lisa. Jimmy Carter, the 39th President of the United States, died at his home in Georgia Sunday at the age of 100. The longest living president in U.S. history, Carter's accomplishments during his one term in the nation's highest office included brokering an historic peace accord between Israel and Egypt. He faced several domestic and foreign challenges throughout his presidency, but he refined the post-presidency for U.S. leaders. Bloomberg's John Tucker takes a look back at Jimmy Carter's political career and legacy.
Jimmy Carter served as state senator and governor of Georgia before becoming the 39th president of the United States.
I, Jimmy Carter, do solemnly swear
that I will faithfully execute.
That I will faithfully
Carter's tenure in the Oval Office was tumultuous, marked by inflation, a recession, and an energy crisis. His final year in office was marred by the Iran hostage crisis. After politics, Carter committed much of his time to peacekeeping and humanitarian efforts, like Habitat for Humanity.
Join us with Habitat for Humanity as we rebuild homes and lives.
Jimmy Carter was the longest retired president and the first to live past the age of 95. John Tucker, Bloomberg Radio.
Mourning the passing of the former president, President Biden, delivering remarks in St. Croix late Sunday, remembered Carter as a good family friend.
Jimmy Carter was just as courageous in his battle against cancer as he was in everything in his life. Cancer was a common bond between our two families, as in many other families.
Carter spent about 22 months in hospice care. South Korean officials are struggling to determine what caused a deadly plane crash that killed 179 people on board in the country's worst aviation disaster in decades. Acting President Choi Sang-mok today presided over a task force meeting on the crash and instructed the Transport Ministry and police to launch investigations into its cause. 2 people survived the crash. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr, and this is Bloomberg. Paul, Jess, and Lisa.
All right, Michael Barr, thank you so much. We appreciate it. Cocoa market resumes gains as production concerns linger. It's this whole chocolate thing. I mean, cocoa, the prices have just been going crazy. Cocoa and coffee.
Yes.
2 of the commodities that have had these huge gains. I'm looking at coffee here, GLCO, the global commodity price screen here on the Bloomberg terminal, up 70% year to date. So if you're getting your double, well, I get the double short mocha, but crazy.
I'll admit, I'm taking in a lot of coffee and chocolate, so
yes, so
especially in the last few weeks.
Yeah, so it's just you see some of these commodity prices, and it goes to the cocoa up 152% for chocolate. So
I believe it.
Yeah, so it's just, it goes to what I've learned from looking at this little map in my Starbucks is there's a little map around the globe, kind of around the equator.
Like the app, you have a...
Yes,
yeah.
And you can see this, and that's where you grow coffee, is in this little, around the equator, all around the globe. Unfortunately, they're having droughts in many of the parts where they grow coffee. So there you go. There's your coffee report.
Sounds like this is how the app hooks you. Yeah.
It does. Exactly. So cocoa up 152% year to date. Not good for our chocolate fans. Coffee up 70%. So we are all over this commodities. Maybe we'll talk to Mike McGlone, Bloomberg Intelligence commodity guy, figure out what's going on out there.
Miami Mike.
Exactly. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
This Futures Report sponsored by IBKR. Markets never sleep, and neither does Interactive Brokers. Discover opportunities with CME Group Futures across equity indices, interest rates, FX, energy, and more. Access CME Futures around the clock at Interactive Brokers. All right, futures really deteriorating. This is after the holiday shortened week ended with a big sell-off in the tech sector Friday. Shares of mega caps took a hit, so let's check in with them this morning. We have Tesla down more than 2%, Apple down more than 1%, same for Amazon, and Nvidia down about 1.5%. Since we mentioned Nvidia, let's check in with some other chip makers. We have Broadcom down more than 2%, Intel down more than 1%. So NASDAQ futures down more than 1% at 237 points. Dow futures down 0.7%, 335 points. S&P futures down nearly 1% at 58 points. The two-year yield 4.28%, down 4 basis points. The yield on the 10-year 4.57%. That's down 5 basis points. We head over to commodities. We have Brent crude $74 a barrel. WTI crude $70 a barrel. We have spot gold at $2,618 an ounce. Over to Bloomberg dollar spot index. That's little change. We have the Japanese yen up about 0.1%. Same for the euro and the British pound. Bitcoin is little changed, up about 93,000. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Vanderbilt University, I toured that for the first time 3 months ago. Alex and I were down there doing a remote. What an awesome university. Why I didn't think about that in high school, I have no idea.
So many of my friends that toured it say the same exact thing. Beautiful.
I mean, just amazing school. And our next guest is a proud graduate of Vanderbilt. Rayanne Mitrione, partner at Callan Family Office, joins us. Rayanne, I'm looking at your notes, and you put something there that I hadn't thought about it this way, but the S&P has annualized north of 15% return over the last 5 years. I mean, I thought I was really smart. But the reality is I'm just kind of along with the ride with everybody else here. What do equity investors, what are you saying to your clients here for 2025 in terms of expectations, given the really strong results we've had over the last 5 years?
I mean, it's been an unbelievable run, right? We've annualized, like you said, over 15% the last 5 years. And if you look at last year and this year, we're north of 25% for these 2 years. So I would caution them not to necessarily expect to see the same type of returns going forward. We're still very positive on equity markets, but would expect to get more into a normalized level. I mean, even if you look back the last decade, we've annualized at over 13% for the S&P over 10 years. And that's highly unusual. And we've been in generally a low interest rate environment, and that's been really supportive of that. But we should, as things start to normalize, we would expect those returns to come down going forward.
So if we see a near-term pullback in the equity market, are you going to use that as a buying opportunity?
We would view that as a buying opportunity and wouldn't be surprised to see some of that. We've seen a little bit of that softness in the last few weeks, and would not be surprised to see some profit taking in early January once we're in the new tax year. Investors are going to want to do some rebalancing potentially. And we do. We're very constructive on the equity markets. Our allocations have grown, so we've been rebalancing. But if we were to get a pullback, and we're not expecting anything too significant, but we would view that as a buying opportunity.
Rayanne, for our listeners and viewers outside of the U.S., the international markets have lagged the U.S. pretty substantially over recent years. Is that a value trap? Should we be looking at some of these international markets just from a valuation perspective, or stick with the U.S. market where the growth is more proven?
We are certainly more optimistic when it comes to U.S. markets. We do build diversified portfolios. We do have allocations to non-U.S. equities. But it has been, we've seen over the last 10 years, S&P is up 13% on an annualized basis. You look at the EFA index, it's up 5%. So there's been this huge outperformance by U.S. markets, but that continues to be really where the growth is, really where the earnings are. And outside the U.S., you just have a much smaller, far fewer companies in the technology space. And that's been a big reason for the divergence as well. So we would expect U.S. to continue to outperform going forward and are remaining overweight in our client portfolios.
And to Paul's point, if you look at U.S. stocks relative to their international counterparts, if you're looking at the MSCI excluding U.S., I mean, it's on pace for U.S. stocks' best outperformance there this century, and actually the best since around 1996, 1997. So where exactly kind of internationally, obviously to your point, you're still going to be funneling money into U.S. stocks, but if you're thinking about either emerging markets, obviously you have a lot of diverging central bank policies globally, but what particular areas internationally do you like, and which ones would you shy away from?
We do invest broadly internationally, but more on the developed side relative to emerging markets. We do have some small allocations to emerging markets as well. And to your point, the valuations, certainly are low, but it could be, they are low in some ways for a reason. But we do have allocations across Europe and Asia and broad emerging markets as well.
Rayanne, talk to us about alternatives. I'm thinking private equity, private debt, hedge funds, that type of thing. What's a typical allocation in your family office, and kind of where do you allocate some of that alternative capital? Because I think a lot more investors are thinking about alternatives than maybe they did a decade ago.
Yeah, and we view it as a great diversifying tool and a way to be able to enhance returns if you're able to really access the best managers in those spaces. So we typically would include a 15 to 25% allocation to alternatives across all those areas you mentioned for an investor who doesn't have any constraints or restrictions for various reasons. And if you look at the U.S. and companies that have revenues in excess of 100 million, 87% of those companies are private. So if you're only investing in the public markets, you're limiting your opportunity set by a great deal. And especially when you're looking at a lot of the technology companies and companies that may be emerging in areas of artificial intelligence, a lot of those are private. And so it gives you a lot more opportunity if you're able to invest in those areas.
And Paul, I know you've always said in a second life, maybe you'd go more toward the private credit type corner of the market. It's interesting because it looks like it's trying to have more of an expansion toward corporate lending here. How do you view more specifically the private credit markets, Rayanne?
Yeah, that's an area that's gotten a lot of attention over the last couple of years, especially as interest rate, when interest rates were lower and as they're coming up and banks hadn't been as loose on lending. So we've invested in a great deal of private credit opportunities, and we continue to view that as an attractive area to complement our traditional fixed income portfolios. So we have, of course, our high quality investment grade bonds, typically in municipals, because a lot of our clients are taxable investors. But we do build around that with private credit in a number of different areas, and you can get enhanced returns. And it serves as a nice diversifying tool as well.
All right, Rayanne, thank you so much. We appreciate that. Rayanne Mitrione, partner at Callan Family Offices here. Yeah, the private credit business has been an extraordinary source of growth. And I guess, from what I understand, talking to the folks that are in that business, it was kind of an outgrowth of the great financial crisis, when some of the banks coming out of the great financial crisis, for a variety of reasons, including some regulatory reasons, were a little bit more restricted on the type of lending they could do and what they could hold on their books, which created an opportunity for some of these private credit providers to step in and provide maybe some of the more risky credit out there.
Right, and there were a lot of interpretations that maybe as you saw interest rates aggressively going higher the last few years, you wouldn't see the same outperformance, but it continues to defy expectations, Paul. Yeah, it has been. It's been really a source of capital for a lot of industries, including the commercial real estate business, which is a business that Alex Steele and I on our Bloomberg Intelligence program spend a lot of time focusing on the commercial real estate business. How much risk does that pose to the U.S. economy, to the U.S. banks? When are we going to see some really significant write-downs? And what we hear from a lot of those investors in the commercial real estate business is that private credit is a source of capital for growth in the business, as maybe some of the banks, particularly some of the regional banks, step back from their real estate lending a little bit. Looking at the futures here, we have red on the screen. The S&P is off about almost 1%. NASDAQ's off 1% here, so a little bit of a rollover here. Volumes are fairly light. The VIX pushes out. We're now just under 18 on the VIX. I'll call that out for Tom Keene. 10-year Treasury yields pull back about 5 basis points. 4.57%. WTI crude oil rate below $71 per barrel. This is Bloomberg Morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks adding to Friday's declines on Wall Street. This is over a pullback in the Mag 7 tech mega caps that have really powered this year's rally. Right now, NASDAQ futures down more than 1%, 234 points. Dow futures down about 0.8%, 350 points. S&P futures down 1% at 460 points. The two-year yield, 4.28%. That's down 4 basis points. The yield on the 10-year, 4.57%, and that's down about 5 basis points. Taking a look at the holiday trading schedule. The market's open tomorrow for New Year's Eve. The bond market closes at 2 p.m. Wall Street time. Remember that. Exchanges in London, Hong Kong, they're closing early tomorrow. There is no trading in Japan. And as for New Year's Day, yes, U.S. stock and bond markets will be closed. Over to the Bloomberg Dollar Spot Index, that is little change. We have the Japanese yen up about 0.1%. Same for the euro. The British pound is little changed. Shares of Nissan lower in Tokyo, down more than 5%. This is over concerns that its planned deal with Honda would give investors that lower stake in the proposed joint holding company. And since we're talking cars, well, some good news if you're in the market for a new one. J.D. Power says discounts on the dealership lot in December, they were up 25% from a year earlier. Experts telling the Wall Street Journal it's expected to continue into the new year. Inventory jumps to pre-pandemic levels, and those stronger promotions, well, they're helping boost overall U.S. vehicle sales. So a win-win for everyone. There you go. That is your Bloomberg Business Flash. Paul and Jess.
All right, Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Jess, I got a big problem with our next guest here. Not only does she have an undergraduate degree, but also a master's degree from the University of North Carolina at Chapel Hill.
Rivals.
I'm wearing my Duke socks today.
That's
I'm going
right.
to bite my lip. I'm going to be a gentleman. Paige Henderson joins us, Senior Portfolio Manager at Allspring Global Investments. Paige, thanks so much for joining us here. Boy, what are you telling your clients here in your letter for about 2025? What are you setting? How are you setting expectations for your clients?
Well, good morning. I think our strategy, or any international strategy for your average client, it's a piece of their diversification, and that recently the international stocks have sold off relative to the U.S. But you also have to look at how that is it all Mag 7 and what's going on in the U.S. underneath the Mag 7. So that hasn't been particularly strong. But why do you own these stocks? You own them for the diversification of. You think about what happened in 22 when valuations came in, they have lower valuations. You also own them to complement your income stream, to add to your fixed income, because these stocks have organically in IFA, particularly in Europe, they have higher yields. And so you're buying your dividend stream at a lower price because the multiples are lower on these companies. Part of it is the mix within the sectors. As you know, we talk about the Mag 7, the U.S. market has become more and more growthy. And in IFA, there's not as much exposure to technology. There are names that are good technology names, but actually in our global strategy, we kind of lean into the U.S. names that have higher yields. But you get a good combination. So if I were executing on my New Year's resolution to diversify, you want to look at the international stocks. Now's a great time to add to international. A lot of the European names pay annual dividends, so you're moving into a period of time where you're going to be clipping a bunch of coupons, and that adds stability if the markets get choppy.
On the flip side of that, what quarters of the market are you avoiding?
We're generally fully diversified. We do lean into companies that have high global exposure and are market leaders. And so, we don't embrace smaller cap names. We don't embrace companies with limited, we're not going to buy a company that only does business in, say, Austria or something. Our companies are global competitors to the U.S. companies. And this is where we see a huge opportunity for some really marquee names that have been weak. I think combination of, their consumer discretion names or consumer staple names, combination of their exposure to the U.S. and worry about the Trump tariffs that we don't know how that's going to play out, but also the exposure to the Chinese consumer. So I think as we move out of 24 and into 25, the market's going to have more visibility on the strength of those franchises.
Barclays, global investment bank. Why do you guys like it?
Yes. Well, I think as we're moving into this new world of interest rates, we need to consider our options in the financial sector. And Barclays is a global player. Much like our industrial names or our consumer names, we like having companies that have exposure to not just one market. And Barclays is primarily UK and US. They're also they have a lot of business as an investment bank, which would benefit from, I think the change that the market is telling us is going to happen in the world. There's a lot of change going on in the world, and the investment bankers, take advantage of that. And also they have some organic catalysts. They are looking to improve their profitability, mainly taking some capital out of investment banking by being more efficient and distributing it into their other businesses. And the U.S. investor is probably familiar with Barclays. I have a Barclays American Airlines card. That's one of their big businesses in the U.S.
I'm curious your view when it comes to banks, because they've had such a banner year so far, and you're seeing hedge funds continue to pile into shares of financial firms. So how do you view on how to position in that corner?
I will say that I'm historically more negative on banks than I probably should be. That was a thing a bias that was a drag for us this year. I think banks, at the end of the day, they're levered exposure to the global economy, and they also have a lot of regulatory risk. So they can be subject to things beyond management's control. And, they tend to have a very high beta to negative surprises or positive surprises. So, last year was a better year than anybody expected. Interest rates played to their advantage, and some of the, banks in Europe, some of the smaller, even more levered banks did extremely well. So I think I'm trying to be more neutral and as opposed to underweight. I think that they're a good opportunity. I just kind of see more opportunity that's more predictable in companies that have a more traditional, free cash flow kind of model.
So how do you think about the U.S. versus non-U.S. here, Paige? Because it seems like I've heard over the last 3, 4, 5 months, more and more news stories about international investors just pouring money into the U.S. market. How do you think about that, U.S. versus non-U.S.?
Well, our team is a global team, so we look at both, and I think that there's a great opportunity in both. I lean into U.S. markets through the names that we own. We want to own companies that do business in the U.S., but just because a company is domiciled in the U.S. doesn't mean that they do business in the U.S. And then on the flip side, like Novo Nordisk is probably half of the market cap of Denmark, but they do most of their business in the U.S. and they're subject to U.S. regulators because they're selling, they sell Ozempic and the GLP-1 meds. So it's a global game. Whatever you're doing, you have to consider that. And we look at the international names as a really good way for our clients to invest in great companies that have lower expectations and maybe lower multiples that therefore, help with the income. But I think you can have best of both. And, within our global portfolio, we try to kind of balance the names that have the best opportunity and also drive that dividend. So, we're trying to solve two things at one time. But I do think that the U.S. economy at this point in time is probably has a better expectation. But that also means that, prices would tell you that that's what everybody expects. So if there's a surprise, those names are pretty, the S&P has a lot of positive expectations built into it. And I would argue that after this past quarter, given how much everything's kind of sold off with the tariff fears and the dollar, there's very low expectations in the international part of the market. And you can find stocks that offer similar characteristics, and you're just diversifying within it by company.
Right.
And, just try not to see it as U.S. versus international. See it as almost value versus growth.
Well, something I'm curious about is when it comes to foreign exchange, because you look at the Bloomberg Dollar Spot Index up 7% so far this year on pace for its best annual gain since 2015. So how much longer do you continue to expect dollar strength?
Currencies are very difficult to predict. So it could go more. A lot of it has to do with, relative interest rates. I believe in 2013, the dollar had this kind of a rally for 2 quarters. And that was a tough period for international. But what happens when you have dollar strength, and we're seeing this now, is immediately the stock prices translate back into the dollar at a lower rate. But the companies that do business in the U.S., those earnings will come back to them at worth more. Yep. And I think that's what the market's kind of missing right now. And that's part of what is adding to the value proposition for some of these global multinationals.
Paige Henderson, thank you so much for joining us. Really appreciate it. Paige Henderson, Senior Portfolio Manager at Allspring Global Investments. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Jess, Lisa, we are remembering the life of former President Jimmy Carter, who passed away yesterday at the age of 100. During his presidency, Carter brokered a historic peace accord between Israel and Egypt, but faced challenges including high inflation, an oil shortage, and the Iran hostage crisis. After leaving office, Carter founded the Carter Center and was awarded the Nobel Peace Prize in 2002 for his decades-long efforts to promote peace, democracy, and human rights. We get more with Terry Haines, founder of Pangaea Policy.
Carter and, ironically, Richard Nixon, whose own difficulties did so much to bring Carter into the White House, ultimately really defined the post-presidency in a lot of different ways. A lot of what's been said about Carter post-presidency accurately about peace and advice and all the kind of back scenes work was also engaged in by Nixon to some extent, and they really changed the way that presidents dealt with their post-presidency.
Terry Haines, founder of Pangaea Policy. President Biden delivering remarks in St. Croix late Sunday remembered Carter as a good family friend.
Our son Bo died. When he died, Jimmy and Rosa were there to help us heal. Jimmy knew the ravage of the disease too well. He lost his father, his brother, his sisters to this terrible disease.
President-elect Donald Trump paid tribute to Carter in a statement saying he did everything in his power to improve the lives of all Americans. For that, we all owe him a debt of gratitude. From former President Barack Obama, Michelle and I send our thoughts and prayers to the Carter family and everyone who loved and learned from this remarkable man. A U.S. team of investigators is heading to South Korea to help find the cause of an airliner crash that killed 179 people on board. 2 crew members were pulled from the wreckage alive. Global news 24 hours a day and whenever you want it with the Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Lisa.
All right, Michael Barr, thank you so much. We appreciate that. Looking at the markets here, we got a little bit of a sell-off here in the futures markets. S&P off about 1.1%. The NASDAQ off 1.3%. Yields, 10-year Treasury yield off about 6 basis points here, 4.56%. So we'll keep an eye on those markets. WTI crude oil, that's trading a little bit higher, just under $71 per barrel. I watch Landman. I know all about the oil and gas business these days. Bloomberg Surveillance is brought to you by PIMCO, a global leader in active fixed income for over 50 years with deep expertise across public and private markets. Learn more at PIMCO.com. Bitcoin, going to call that out for Tom Keene, $93,000, just under $93,000 per token.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got futures falling, and this is after a sell-off in big tech stocks really sent the major averages sharply lower to end last week. We'll start with NASDAQ futures down nearly 1.5%, 312 points. Dow futures down about 1%, 431 points. S&P futures down more than 1%, 73 points. We have the 2-year yield at 4.27%, down 5 basis points. The yield on the 10-year 4.56%, down 6 basis points. We have Brent crude $74 a barrel, WTI crude $70 a barrel, spot gold at $2,613 an ounce. And the Bloomberg Dollar Spot Index, that is little changed. Few companies making news, AT&T and Verizon, they said they were hit by the China-linked Salt Typhoon hack, but their networks are now clear. And Elon Musk's growing influence in U.S. politics, changing the way some countries are looking at his Starlink internet business. Bloomberg reporting a lot of governments are removing obstacles, making it easier for its operation in their markets. And finally, this story, just because, the internet's favorite baby hippo. We're talking about Moo Dang. It has a new fan. The Independent reporting that crypto tycoon Vitalik Buterin has donated $293,000 to a Thai zoo, now becoming its adopted father. That is your Bloomberg Business Flash. Paul and Jess.
No idea what that whole story was about, but I'll take it. If Lisa says it's a story, it's a story. Lisa Mateo, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to that YouTube thing, that's the internet, and search Bloomberg Podcast, and that's where you'll find us. Bloomberg Surveillance today is brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, what are we doing in the credit markets here today? I know that they say the spreads are tight. Spreads versus treasuries are very tight, so therefore it's expensive. But boy, I'm looking at the INGO function on the Bloomberg terminal. That gives you the Bloomberg Index browser, and it gives you all kinds of fixed income benchmarks. And the two best performing in the U.S. were high yield, 8.1% return, and U.S. leveraged loan index, 8.6% return. So you definitely got paid for taking credit risk in 2024. How about in 2025? Well, our next guest can help us out there. Winnie Cisar, Global Head of Strategy at CreditSights. So, Winnie, again, it seemed like investors were really paid for taking risk in 2024. What do you think about 2025?
Yeah, people were absolutely paid for taking some risk in 2024, which was a view that we had aligned with. But we've been shifting down our risk tolerance, and we actually went underweight credit risk with our 2025 outlook. And this is not necessarily because we think that, spreads are just too tight, but we think that kind of the balance of risk reward here does feel a bit stretched, even though all-in yields are still quite attractive, over 5% for investment grade, over 7% for high yield. We just think that some volatility is probably likely to come in the beginning of the year.
What do you think that tells us about the direction of the economy?
Yeah, so usually credit spreads are pretty good at kind of forecasting the direction of the economy. But I think that at this point, perhaps credit spreads are pricing in a little bit too much of the good and maybe not enough of the potential headwinds. We do think that there is the potential for corporations to benefit from things like deregulation, from the extension of tax cuts. But on the other side, there are a lot of questions around what does trade policy ultimately look like? What is the direction of the Fed's path for monetary policy? Are we actually going to see continued easing in 2025, or do we see inflation start to become more of a challenge again? And that would definitely flow through into corporate earnings. And so we do think that perhaps credit spreads are a little bit too optimistic at this point.
Winnie, what's your base case for 2025 in terms of the U.S. Federal Reserve? It seems like maybe the market's pricing in maybe 2 cuts this year. How do you think about it?
Yeah, so the market has really repriced its expectations for the Fed a number of times. That's been one of the defining characteristics of this Fed, both hiking and easing cycle, that the market is constantly kind of getting ahead of itself in terms of too many rate cuts being priced in. At this point, we have a little bit more hawkish expectation for the Fed. We do expect that the policy rate ends the year around 4.5%, which would indicate no Fed cuts over the course of 2025. Now, this could be because the Fed continues to cut rates, although we do think that the December presser with Powell indicated probably a near-term hold is more likely, especially if the inflation data do not continue to moderate, or if the labor data remain relatively strong, or we could just see kind of this Fed on an indefinite hold, an indefinite pause. We've seen that in prior periods, especially kind of in the mid to late 1990s, and we see a lot of kind of similarities to that period as we have today.
Break down the latest of when it comes to the corporate bond ownership and how non-U.S. investors remain the largest class of owners of U.S. corporate bonds, followed by life insurance companies as well as mutual funds.
Yeah, so when we think about the technicals of the market, this is a really important driver. And I think one of the really important drivers of why credit spreads are so tight right now. You have historically kind of the core institutional base of owners, things like life insurance companies, pension funds, those investors who buy bonds to hold them to maturity. They don't trade them around. They want the income that's generated from the coupon. And then you have a few different cohorts of investors that tend to be a little bit less sticky in their investments. This is sometimes some of the non-U.S. investors because they do tend to up and down their allocations to U.S. credit depending on what is going on in the broader global economy, in their domestic economies, and also what's going on within FX. And then we have the retail investors, so ETF and mutual funds, and we've seen a pretty significant increase in holdings of ETF and mutual funds. Usually those are the first ones kind of out the door when you start to see some volatility in the market. So the fact that we have a higher concentration of holding in that less sticky investor base is something that could drive some volatility over the course of 2025 if some of those investors start to get spooked by perhaps negative headlines or a renewed round of recession fears or stagflation fears.
Winnie, talk to us about credit. How's credit quality out there? I haven't heard any really bad stories about credit quality. I'm not sure why that is.
Yeah, so I think that this is one of the kind of bright shining spots for credit right now. Credit quality is generally pretty okay. We had credit really be a tremendous beneficiary from ultra low borrowing costs in 2020 and 2021, combined with earnings that really beat expectations for a number of the periods in the pandemic and even following the pandemic. And that left credit fundamentals in really solid shape overall. Now, they have moderated. They've definitely reapproached what we would kind of view as average or kind of long-term normal levels. But we haven't seen a massive spike in defaults that a lot of people were expecting in 2022 and early 2023 when the Fed started hiking rates. And even some of those asset classes that are much more leveraged, like the leveraged loan market, where we've seen a lot of sponsor-backed activity for LBOs and M&A, they've held in relatively well overall. We do think that we're moving into a bit of a transition period. If borrowing costs remain somewhat elevated because the Fed is not able to cut rates as much as people want them to or think that they should, or if Treasury yields just remain elevated because you have other inflationary forces or deficit concerns or a whole host of factors that could keep Treasury yields a bit sticky, then you are going to need to see earnings generation be very strong as well to kind of offset that perpetually elevated borrowing cost. And we do have some concerns that perhaps the type of earnings momentum that people are expecting to see corporate America generate in 2025 is a little bit optimistic right now.
Winnie, I'm sure you're diversified in your portfolios, but you are not diversified in your education. Look at this. She gets her undergraduate degree at Emory University. Okay, great school down in Atlanta. Awesome. And then she stays for another 4 years getting her JD MBA. I mean, that's 8 years at Emory University. I mean, I guess you liked it there, Winnie. Good school and all. JD MBA, really?
Yeah, I mean, it was a great opportunity, and a sad day with the passing of President Carter.
Yep.
But we did benefit from the Carter Center, and he spoke at Emory a number of times, which was always a delight.
Very good. Just such an awesome school down there in Atlanta, Emory University. I mean, they've got the law school, the business school, the medical school.
They've got it all.
Everything. It's just awesome down there in the great city of Atlanta and down in Georgia. I'm sure mourning the passing of President Carter. Winnie Cisar, Global Head of Strategy at CreditSights. We appreciate getting a few minutes of your time. This is Bloomberg. Good morning.